Hello and welcome to CNBC TV 18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. Now, Morningstar India has just released their first study on investor returns versus fund returns and the key lessons that this can bring to the fore. This inaugural study of investor returns finds that investors have earned about 7.8% per year over a 3-year period, 6.3% over a 5-year period, and 6.5% over a 10-year period across fund categories. But how does this compare to fund returns themselves? That's the question we'll be asking today. Kaustubh Belapurkar, Director of Fund Research at Morningstar Investment Advisers India, joins in to talk about this and more. Hi, Kaustubh. Thanks very much for joining in. But first, the very basics. What do you mean when you say investor returns and fund returns? How are they different?
Sure. So, hi, and thanks for having me on the show. So when you think about the classical context, when you think about returns for a fund, right? It's the published return on a fund. When you look at it, it's basically calculated via the NAV, right? The NAV of the fund. That let's just take a simple example that there was a fund that was launched 3 years ago at an NAV of 10. 3 years hence, it's sitting at an NAV of say 14. So 40% absolute and about 11.9% CAGR return. That's the fund return, right? But that's what you would have earned had you invested on day one and stayed invested for the entire 3-year period. But as we all know that funds are obviously susceptible to inflows and outflows, and investors come in at different points of time, right? So while the fund may have returned this, and this is a question that I think all of us in the industry get asked very often. That investors will come with queries that, hey, when I look at the fund returns, the fund's been doing exceedingly well, but how come my return doesn't seem to stack up? And the simple answer to that is the concept of investor returns, right? So like I said, investors will come at different points of time in the the journey of the fund. So even if you're looking at 3, 5, 10 years, there'll be different sets of investors at different points in the fund, and each of them will have a different experience. Someone who came and stayed, bought and hold, held the fund till the entire period will obviously earn what the fund return was. But someone who came 1 year, 2 years, whatever period down the line would have a very different experiences compared to the fund return, right? And so the investor return, very simply put, right, is the return an average rupee invested in the fund has made, right? So let me elaborate this to a very simple example. Assume that you had a fund that started 3 years ago, and there were about 1,000 crores of money that came in on day one, right? The fund returned 10% in the first year. Then again, another 1,000 crores of fresh investors came in. So the existing investors stayed put, no one redeemed. It's a hypothetical scenario, and 1,000 more crores came in at the start of year 2. The fund again returned 10% in year 2. In year 3, another 1,000 crores of fresh investors came in. The existing investors stayed put, but the fund in the third year made a negative 10% return, right? So you see year 1, year 2 plus 10%, year 3 negative 10%. So when you do the math, the fund return on an absolute basis would be about 8.9%, and on a CAGR basis about 2.9%, right? So a positive return. But because the investors came at different points of time, so the first 1,000 crores, right, would have made exactly the fund return because they came in and hypothetically didn't exit for the entire 3-year period, right? But the second set, which came in after 1 year, the return for them would have actually been minus 1%, right? Because they first earned 10% positive and 10% negative the second year, so minus 1% on their investment. But the third set of 1,000 crores of investors that came in actually are sitting on negative 10% returns, right? So just look at it, the staggering difference in what this happens. So when you use the function of investor returns, and I won't get into the math of it, but typically it's what we call the internal rate of return over the period, you will actually realize that the investor return, or the average rupee invested in this fund, made a minus 0.04% return. That means the gap, while the fund made 2.9% positive, the average investor, the average rupee invested in the fund actually made minus 0.4% negative return. And that's really the gap because of the different times that investors come in. And that's really what the concept of investor return is.
Understood. Kaustubh, now that we've got that out of the way, if you can explain the various moving parts, what are the categories of funds you have covered in your study, and anything else we should know before we get to the study itself?
Sure. So I think what we've tried to do is make it as broad-based as possible. So we've tended to look at all the broad diversified categories, but we also look at some of the specialized categories. Say, for instance, within equity, some of the sectoral and thematic funds. Or for instance, within fixed income, we've looked at most of the prominent categories. But what we've also done is we've excluded some of the categories where we expect that typically, the investor caps won't be large anyways to start with. For instance, liquids, overnights, the ultra short durations, low durations, because, those are more sort of steady sort of return funds, right? We've also excluded things like arbitrage funds, but I think otherwise, pretty much all the other 70 categories, be it across equities, fixed income, allocation, even gold, have been under consideration in our exercise. And I think what we've tried to do is while we've looked at it at an individual fund level, we've also then rolled it up to a category, an asset class, and finally an overall industry level. So for instance, the numbers that you showed to start with was at the overall industry mutual fund level, obviously with the exclusion of the categories that I mentioned, but it's a different experience at an overall industry level, but also very different from across asset classes and fund categories, which we'll obviously discuss later in the show.
So, Kaustubh, we know the fund returns that your study has come up with across various time frames. But what have been the investor returns in these time frames, and what is the gap, and what are the decisions that this gap accounts for?
Sure. So what we've done is we've looked at it over different time frames, and I'll explain why. So we've looked at it over 3, 5, and 10 years. And traditionally you would want to look at it over a long term, but I think acknowledging the fact that our industry size also has grown quite significantly over the last 10 years. That's why we also looked at shorter time frames to really look at what the industry investor returns have been like, right? So when you look at it from a 3-year perspective, you've got a fund return of almost 10.5%, but the investor return is only at 7.8%. So there's a significant gap of almost 268 basis points. Similarly, for a 5-year period, the overall industry, the average assets, and this is on a weighted average basis, would have been about 8.79%, what the average weighted average funds would have returned. But the investor return is almost 2.5% lower at 6.25%. On 10 years, and like I said, the gap is pretty significant, right? The weighted average fund returns would have been about 12.3%, but the investor return is almost just half that at 6.54%. That means the gap is about 5.8%, which is staggering. Now, obviously, like I said, as the industry matures and assets, the base keeps increasing. Maybe the gap will come down, but even if you look at it over the short-term basis, we can see that these gaps are pretty significant. At 2.68 and 2.54% over 3 and 5 years. If I were just to compare it to a market like the US, where we've been doing this study for many years, typically the gap is in the region of 1.5 to 1.75%. So I think India will get there at some point in time. And I think some of the reasons when you think about this gap are largely to do with the fact that, I spoke about that investors try to come at different points of time. They try to time the market. They try to chase some of the trendy funds, the funds that have done well recently. All of these, what we call behavior gaps, end up hurting investor portfolios because they're taking wrong entry and exit decisions in and out of asset classes and fund categories and even funds. And that's what really hurts their overall portfolio level returns.
So that's true. So every time our portfolio is not performing, we should also remember that some of the blame could lie with us. We shouldn't just blame fund managers. But, Kaustubh, this is the overall scenario, right? Is it different for different asset classes?
Yeah, absolutely, Sumera. So when you look at it, typically for the less volatile asset classes, the gaps will be smaller. So for instance, when you look at the fixed income category of funds, fixed income will typically have the smallest gaps available. Mind you, there will always be gaps. It's a utopian scenario that there are no investor gaps. There will always be gaps because even in fixed income, the various kind of categories, and even within that, gaps could vary. But if you look at it from a bird's eye view, fixed income being the lesser volatile asset class will tend to have the smallest investor gaps because the investor experience, because the funds are less volatile, will tend to be a lot more steady. Even if investors come at different points of time, right? But in the more volatile asset classes, say for instance equities, the gaps will be significantly larger. As you can see, over a 3, 5, 10-year basis, equities, the gaps have been anywhere, about 2.9%, and on a 10-year it's almost 7% in fact, which is staggering, right? So I mean, equity funds on a weighted average earned almost 14.9% on a 10-year basis, but the investor on an average made only 7.57%. So half the return was lost because investors came in at different points of time and obviously made ill-timed entries and exits. So I think that is a challenge. Another interesting bit is something like gold, right? Gold also, we've traditionally seen a lot of money moving in and out. Gold's not done anything for a very long time, and then suddenly there was a spike. But again, investors came in at inopportune moments, and that's where the gaps are large. The other category which is interesting is allocation, right? I mean, typically, and we look at allocation as a sub-segment, but you can see that allocation tends to have lower sort of gaps as compared to equity, clearly because, again, it's a mix of equity and fixed income, and that's where the gaps tend to become low. So I think that's kind of, the way you would look at it. The more volatile asset classes tend to have higher investor return gaps.
Kaustubh, on a 10-year period, I mean, in all of these plates, the only time we have seen a positive difference between fund and investor returns is commodities on a 10-year basis. How did that happen?
I think just sheer luck, to be honest, because I think, given the fact that, we're starting the 10-year period at a time when gold had already started correcting, back in 2012. So the fund returns are also slightly depressed, right? And like I said, 2012 to 18, gold went nowhere. And then suddenly you had this period. So when you look at gold in the shorter term, you can clearly see there's a negative gap because of, in 1920 gold price, I mean, gold is amongst the best performing asset class. Investors came in, much later with their investments into this after gold had already outperformed the others. So the gaps are negative. But over a 10-year period, because just the fact that it didn't move anywhere from, 12 to 18, and there were investments in gold funds at a point of time, so it's just been kind of, just kind of a coincidence rather than actually, by design. I think, across other categories, you can clearly see that there are gaps. And
I was just about to congratulate myself as an investor, but thanks for that. Okay, a quick break. Kaustubh stays on with us. We have a lot more to talk about, and also what are the key lessons that they've been able to learn from this study. All of that is lined up next. Stay tuned. Hey, welcome back to MF Corner. Still with us is Kaustubh Belapurkar of Morningstar India, and we've been discussing their maiden study on investor returns versus fund returns and why investor returns are lagging. So we've got the key numbers, but Kaustubh, within asset classes, what is the kind of variance in these gaps? Like, say, for equity, is it only sectoral or thematic funds where investors are making incorrect decisions? What about fixed income, commodity?
Sure. So let's look at equities first, and it's a very interesting case study. So, like I was saying, that investor gaps will exist across every single asset class or category, but obviously the divergence is very different. So, for instance, when you think about equities as an asset class, typically you would see your more diversified equity funds have smaller gaps. So your large caps, your flexi caps would tend to have smaller gaps. But what the data has also shown us, and which is pretty intuitive, that sectoral thematic funds, which will be pretty volatile because the returns will be very, very lumpy, will have significant gaps. And the classic example that we've seen over the past few years, and the study throws that up. For instance, technology funds, right? Now, technology as a sector, post-COVID crash, years 2020 and 2021, it was amongst the best performing sectors, and obviously the funds accordingly did exceedingly well. The tech funds, right? 2022 obviously has been more challenging. But when you look at the flows from money that's come into these funds post these significant returns having already been delivered, right? So you had a great 2020, you had a great 2021, but a majority of the money's come in either in late 21 or part of this year. So when you just compare that and you look at the investor return versus the fund return, on an average, and this is as of 30th June, technology funds have returned about 27.5%. The investor return for this 3-year time frame is just a meager 2.7%. That means the gap is significant. So most or the average rupee invested in the funds, in tech funds, has only made 2.7% versus a staggering 27.5% that the funds made, right? And why has that happened? Because a lot of money came in post this sharp run up in the tech stocks and the tech funds. So the challenge is that a lot of times investors tend to look at things that have done well recently, sectors and themes, invest, and then wonder why their portfolio or the expectation of returns is very different from what really came to them. This gap needs to be addressed. I think that's something to keep in mind. Similarly, when we think about fixed income or commodities, right? So in fixed income, again, there are various categories of funds, and what we've seen is the bigger gaps have existed in, the typical duration categories, dynamic bond funds or gilt funds, where obviously, investors have again made some poorly timed decisions. Classic case in 2020, we had yields go down. Gilts and dynamic bond funds did exceedingly well in the first half of 2020. A lot of money came into these funds after the sharp run up, right? And obviously, we've seen where yields have gone. So the investors who came in are actually sitting at much lower returns as compared to the funds. So I think that's a very important sort of takeaway from this report, that investors need to keep that in mind. And I think gold, we already spoke about, again, a very similar thing, where money's come in after the sharp run up. So I think the gaps have been significant, across asset classes, but within that, certain categories which are much narrower tend to have larger gaps as compared to the more broader categories.
Okay. Kaustubh, you had mentioned that the least volatile categories have the least gap, right? So naturally, the gap is highest now for the most volatile funds. So what explains this? Is it just because they are more volatile, or do we as investors behave differently with these funds?
Yeah, good question, Samara. So it's actually a mixture of both, right? So the one thing is, obviously, because they're more volatile, I mean, just assume that a fund was earning 1% every month on a consistent basis for 3 years, and investors came at any point of time. Typically, the investor return would have been very similar to the fund return, simply for the fact that it's a very consistent, low volatile fund, right? But if there's a fund, which is extremely volatile, earning 20% in 1 month and minus 15% in the next month, the timing of the investment makes a lot of difference in terms of the investor return. And I think that becomes a challenge, right? At the same time, to your point, because the fund is more volatile, sometimes it just makes eye-popping returns, which attracts investors, right? Because, sometimes, that shows up in the top of the charts, or within asset classes that, something's done 20% over a short time span. And that just natural human reaction to gravitate towards such investments. And that's the challenge which actually broadens the investor return gap.
Okay, fair enough. But Kaustubh, now for the main question, which is how do we as investors improve our odds, right? What are the key lessons that you've been able to formulate from this?
Sure. So I think a couple of very important points. One is, like we said, your core portfolio should always be these broad, widely diversified funds. So, within equities, large caps, flexi caps, mids and small quantity asset allocation, but build or buy mostly largely sort of, well-diversified funds. And obviously the corollary to that is that, try to avoid too much thematic investing. Ideally, most investors are better off not investing in some of these thematic funds, especially if they're not in a position to take this timing call, right? So we can't do that. Do not invest in these. And if you really want to take very, very small size bet, not outsized bets. I think that's two important things from a portfolio perspective. Again, don't chase past performance even within categories of funds, because we've seen that also happening, chasing the flavor of the season, often missing the bus on both ways, which has been a challenge. And the last thing, I think, which is great for discipline, and I'm so happy to see the numbers month on month, is SIP is a great tool, right? For just removing this investor biases altogether. Now, mind you, SIPs will bring in an element of investor gap, but that's explainable, because when you think about it as an investor, SIP plays the most important role in terms of, it's not like you had your 100% of your portfolio to invest today, right? Because if you're investing from your monthly paycheck, it will be only available to you on a month-to-month basis. Obviously, you have a lump sum amount to invest, you'd probably stagger it over a shorter period of time. But otherwise, the cleanest way to invest is an SIP, which just removes those human biases and will help reducing the investor return gaps that we've seen. And like I said, it's a heartening sign to see that that's already happening in a big way. But I think we could make a lot more headway in terms of kind of tuning investor behavior to really building good, solid portfolios rather than chasing performance.
Okay, Kaustubh, one more question. Therefore, does it mean that for an investor, they would be better off in maybe, say, not the top fund, maybe one of the funds in the middle somewhere, but if they stay the course rather than keep churning between the top performers?
Absolutely. So I think that's a very good point, Samara, that you identify those funds which are more consistent or you think will be more consistent and just stay invested because, funds will go through cycles of underperformance. And the worst thing that you can do is exit that fund and buy the top performing fund of yesterday, because then it'll be like a double whammy. You're probably losing out on a future good performing fund and buying into a fund probably too late. And, it'll hit you both ways, right? So I think that's a very important thing to keep in mind. Identify well-diversified, well-managed funds and just stay invested. Cut out the noise. You'll actually do a much better job than trying to swing between top performing funds, every year or so.
Yeah, I think that's where the dilemma lies, right? For most people, is that they feel that their fund may not be doing as well as the next, but just staying on and letting it compound will probably be more beneficial for them, right? Over the longer time frame. Kaustubh, thank you very, very much for joining in and for sharing these numbers with us. And, if to end, we just have those numbers again, let it be a reminder to us that sometimes it may be our own behavioral impulses which are eating into our investor returns, and which is why when we compare it to fund returns, we're sometimes disappointed. But once again, it's not always the fund manager's fault. So we also need to be disciplined in our own approach. Thank you very much for watching. I hope you found this informational. That's all we have. Stay tuned. The team of Closing Bell joins you next.